What is going on, Wade Trade Brigade? Today, we're going to be talking about how the Federal Reserve works as far as monetary policy goes. Number two, how they can actually affect the economy. And number three, we're going to be talking about how they can literally create or destroy inflation. So let's get right into this. If you actually take a look up here, I'm going to show you what I have on screen. Now, this is a wonderful article. I found this article on the internet and it talks about the reserve requirement and how it actually affects the interest rates. So we're just going to read through this really quick and I'm going to stop and explain some things as we go through the article. So starting from the top here, the reserve requirement is the total amount of funds a bank must have on hand each night. It is a percentage of the bank's deposits. The nation's central bank sets the percentage rate. In the United States, the Federal Reserve Board of Governors controls the reserve requirement for member banks. The bank can hold the reserve as either cash in its vault or as a deposit at its local Federal Reserve Bank. So we're going to switch back and forth to this article quite a bit in this video. I'm going to take you over to the Federal Reserve, or not the Federal Reserve, St. Louis Fed. This is the website where you can find all kinds of monetary policies, really anything you need to know about the Federal Reserve and their policies. So this right here, this is the reserve requirements, okay? The last time that this was changed was on March 15th, it was effective March 26th, but it was actually announced on March 15th, 2020. The board reduced the reserve requirements to 0%. Now let's talk about reserve requirements and how this affects things. So let's check out back at this article how the reserve requirements work, okay? Suppose a bank has $1 million in deposits. Each night it must hold $100,000 in reserve. That's about a 10% rate. That allows it to lend out $900,000. That increases the amount of money in the economy. The loans help businesses expand, families buy homes, and students attend schools. Having $100,000 on hand makes sure that it is enough to meet the withdrawal needs. Without the reserve requirement, the bank might actually be tempted to lend all the money out. And then if people try to come and get their money out, they have no money to give them. So here's what happens next. If the bank doesn't have enough on hand to meet its reserves, it borrows from another bank, right? It may also borrow from the Federal Reserve discount window. The money that banks borrow or lend to each other to fulfill the reserve requirement is called the federal funds rate, okay? The interest they charge each other to borrow Fed funds is the federal funds rate. All other interest rates are based on that rate. So now I've pulled up the stlouisfed.org, and this is going to show you the federal funds rate, okay? This is that rate that they're talking about, the borrowing rate between banks. Right now, we are very, very low historically. We're at about January 2022, 0.08. That is extremely cheap, extremely cheap. Now, what that encourages is borrowing, okay? That way the banks can lend out more and more money, and it's cheaper for these banks to do so and borrow from one another. So moving back to this article right here, the Federal Reserve uses these tools to control liquidity in the financial system. When the Fed reduces the reserve requirement, it's exercising expansionary monetary policy. That creates more money in the banking system. When the Fed raises the reserve requirement, it's executing contractionary policy. That reduces liquidity and slows down economic activity. I know that was a lot of information, so let's recap very quickly. Basically, the reserve requirements are used to affect liquidity within the banking system. If they raise the reserve requirement, that means that banks have to hold on to more cash and it reduces liquidity. However, if they lower the reserve requirement, it increases liquidity and encourages banks to loan out more money. So now that we've learned a little bit about the reserve requirements, let's go look at some more economic data and then try to tie all of this together. So here's the next thing I want us to look at. Personal consumption expenditures. This is a price index that measures the change in prices of goods and services consumed by all households and nonprofit institutions serving households. So within the PCE, personal consumption expenditures, there are two different types of goods. We have an example of non-durable goods. Non-durable goods include food and drinks, right? Services include auto repairs, haircuts, things like that. Things that are usually consumed rather quickly. Then you have durable goods. Durable goods are like appliances, right? Washers, dryers, refrigerators, air conditioners, computers, televisions, jewelry, cars, trucks, things that last a lot longer and that you don't really need to purchase that often. So now that we know exactly what these personal consumption expenditures are, let's go over here to the personal consumption expenditures chart. Okay, again, this is back at the stlouisfred.org. This is where you can find all of the economic data. Okay, what does this chart tell us? From December 2020, it went from 14,389 to December 2021, 16,306. So this is actually quite a large increase. If you go over here to this percentage calculator, our initial value was 14,389, final value 16,306. That is a 13% increase in personal consumption expenditures. So this is one of many factors to consider whenever you're looking at the macroeconomic situation. Let's look at a couple other factors. One of those other factors is actually the average hourly earning of all employees. Okay, so let's take a look at this graph here. If you see, back in December 2020, it was $29.92. Now here in December 2021, we're at $31.40. Let's go back again to this percentage calculator. Basically, if you do the math, that's almost a 5% increase in wages. Now, we got a 5% increase in wages, but what if we go back to our PCE, personal consumption expenditures? That increased by almost 14%, not really, 13.3%. So this is an important factor to consider. This means we're literally buying more with less money. Let's break this down just a little bit further. So let's go to personal consumption expenditures, non-durable goods specifically. If you look at this chart, we can tell we've definitely gone up here. And again, I took it into this calculator, and that would actually be an increase over December 2020 to December 2021, 16.1% increase. That is very large. Now remember what non-durable goods are. They're things that don't last very long, right? Food items, things that you reuse like shaving cream, haircuts, food, things like that. Then let's go to the durable goods. And again, another large increase. And if you go to the percentage calculator, that's going to be a 15.6% increase. Now, again, why am I telling you all this? I'm telling you all this for a reason. We're hitting several different things, and then we're going to tie it all together. The next thing that we're going to look at is total business inventories. Yes, I know some of you probably watch other videos, especially with Cathie Wood in them. I stole this one from Cathie Wood. I think it's a phenomenal point to make. Total business inventories. This is crazy. Look at the amount that this has increased from July of 2020 to now. That is almost at an exponential curve up. That is an unbelievably sharp increase in total business inventories. Now, total business inventories has gone up. Why? Because let's look at personal consumption expenditures. We have been buying more, period. So it makes sense that if we're buying more, that means we go back over here to the total business inventories. They would be getting more inventory to sell us stuff. So I know we've gone over a lot already. So let's recap, okay? The first thing is that we know that the Federal Reserve has actually raised reserve requirements, okay? Now, what does that do? That encourages banks to lend out more money. Now, because banks are lending out more money, more people are spending money, all right? Not only on non-durable goods, but also durable goods. Now, what does this do? These companies continue to make more money, therefore being able to pay their employees more money. You can see these average hourly income, average hourly earnings going up and up and up. Now, once this happens, you see total business inventories going up because people are buying so much. Now, one thing leads to another, and eventually you get to the federal funds rate. The federal funds rate is a very effective tool to cooling off the economy or heating up the economy. Basically, this makes money to borrow cheaper or more expensive based on the actual federal funds rate. The higher it is, the more expensive it is to borrow money. The lower it is, the cheaper it is to borrow money, therefore incentivizing people to take out more loans and spend more money. So here's the deal. If the Federal Reserve raises rates too quickly, it can actually kill all demand for all goods and services. This can really have an impact on the economy. However, if the Federal Reserve keeps the funds rate too low for too long, it can actually create even more inflation. This can be a big problem, creating too much demand, too many people spending money too quickly. And I'll actually even show you a great example of that. If you look right here on this chart, this is the federal funds rate. Right here, when the pandemic hit around March of 2020, you actually had a dramatic decrease in the federal funds rate. This was because the economy basically shut down. People stopped spending money. Therefore, they needed to stimulate the economy, get people spending money, keep businesses afloat, right? And they did this through making it extremely cheap to borrow money. Now, because the Fed did that, it created a lot of demand. Companies saw more profits than they ever saw in 2021. Now, what that led to was this chart right here. If you look here toward 2021 and then into 2022, you saw a massive skyrocket in inflation. This right here is the dreadful start to a hyperinflation mode that the Fed does not want. And in order to tackle this, they need to raise inflation rates. Now, the reason I'm saying this is to not take sides or to scare you, but really it's to show you exactly how much power the Federal Reserve has over the economy, how they can really manipulate the market and the demand. Now, in saying that, I think it's so important to understand what they're doing and what they're thinking. That way, us as individual investors, we can make great decisions for our portfolio. Ultimately, that's really what it's all about. Making great decisions for our portfolio. We need to be the most informed that we can be to further our financial future. Now, if you guys have any different thoughts or want to add to the conversation, throw some comments in the comment section down below and we'll have a great community conversation about it. And if you're one of those people that made it to the complete end of this video, I know that you want to make your financial future better than you could possibly imagine. So you need to basically click on these videos and watch them so that you can learn more to better your future. See ya!